We start off with the market rally, and everything's awesome. That's right. Trump's tweet saying he had a good call with Chinese President Xi. That sent stocks soaring. The Dow at more than 400 points at the highs of the session. The S&P 500 just 1% away from its record. And this coming ahead of tomorrow's big Fed decision where investors are expecting doves to fly. So that's the question for tonight. Is the Fed about to release the doves? And is everything awesome once again, guys?
Well, I love that Chrissy Teigen song. It's one of my favorite songs.
It's your ringtone.
Yeah, it's my ringtone.
Yes, it is.
It's funny, I looked down at my phone when the show started. I'm like, who's calling me at 5 o'clock? I don't think everything is awesome at all. If everything awesome, utilities wouldn't be making all-time highs. You wouldn't have 24% of global sovereign bonds with negative yields. That's just my world. But through the prism of the S&P 500, everything is fantastic. You know, President Trump could say whatever he wants. Great call with President Xi. I'll say it again. I don't think we're any closer to a trade deal with China now than we were 6 months ago. I may be proven wrong in a week. It's happened before. But the fact that the market's here is all on the back of this hope that somehow the Fed has our back. And I think it's madness. If the Fed would emergency cut tomorrow, I think that's madness at the highest level.
If the Fed doesn't deliver on any level, even just taking the patient out of the state, I mean, I don't know what happens.
There's a big risk. I mean, the market's done a lot of the Fed's work for it, right? It's priced in these cuts. Yields are at lows. I mean, look at bond yields in the U.S. 10-year bond yields are the same as Italy bond yields here. I mean, the world has gone sideways here. That being said, if the Fed doesn't come out with a dovish statement or a dovish kind of tone to it all tomorrow, I actually think the equity market is at risk because it's built on this assumption that we're going to get more stimulus out of the Federal Reserve.
So I think a Fed that's preemptive and one that's going to be cutting tactically, which is not really in their mandate, but they have done this before, is very good for equity markets. A Fed that is actually reactive and needs to follow really where we're going on the leading economic indicators, business confidence. Look at that New York Fed yesterday, which was lowest since October 2016 and is closely correlated with the ISM. So these are things that the Fed would probably be saying, hey, this is a reason to move maybe tomorrow. They're not going to move tomorrow. But I'm just telling you that if they're now waiting to July and then possibly even September, that's a Fed that the market doesn't like. So I would echo what's been said already, that markets have priced in the Fed at this point. And I think it's a little bit of a concern to think that the Fed can give you more ammunition tomorrow, even though they do need to begin to kind of restate where they're going to be in July.
It is going so far that now there is a case being floated around that there could be a 50 basis point cut in the offing, and that the last two easing cycles in 01 and 07 started with a 50 basis point cut. So why not this time around?
Why not just go for it? I mean, I don't know if we don't get anything tomorrow. I don't think I think the market may be okay with that, waiting to see. All right, well, in July. And that was really, if we don't get anything by then, that's very different. 50 basis points seems sort of aggressive to me. Just in your dove's cry, people would party like it's 1999.
Listen to you, cranking up your prints there, Karen. Nice.
But I don't know. I got to tell you, I get why the market is up. I get the tweet. I get the Draghi, with that. No sign of improvement would be enough for them to do something. Is that right? I mean, it was a pretty. That's about as dovish as you can get without actually doing anything. But I guess they will. So I get all that. But I think the Fed, I mean, let's see how earnings go. I think I just see a headline coming out of U.S. Steel right now. We're just getting into earnings season. To me, I'm really concerned about not just second quarter, but what companies think about the second half of the year. I'm really concerned about that. I don't think a tweet is enough. I think a deal, not even the hopes of a deal is enough.
And that's actually what Mario Draghi cited, was the uncertainty in the global economy is becoming a drag on the economy. And so that's what the Federal Reserve, that's what the ECB and the Bank of Japan are all dealing with. And to Guy's point, I'm not sure that monetary policy is the fix for this. And I agree. I think we need to see some concrete steps on a deal at the G20. Otherwise, I think it'd be really tough sledding for the market.
It's interesting, though, and we talked about this when President Trump was candidate Trump and he was elected. We said he will somehow use the Federal Reserve as a scapegoat if the market goes lower, and he has set it up perfectly now. And he's talked about it now for months. And think about tomorrow if the Fed doesn't deliver and the market goes down. He has the perfect villain in this whole game.
Well, let me add to that, and that is that, once again today, the reports that they're considering demoting Chairman Powell come out today. Tonight is also a reelection rally for Trump in Florida. He is candidate Trump once again now, right? And so I don't know if that. I'm not going to posit a conspiracy theory, but I'll put it out there.
It's unbelievably coincidental.
But if one were to, I would, say that tweet was very convenient.
It was
the headline is very
extremely
convenient.
convenient.
This is all about 2020, and President Trump, no longer candidate Trump, knows exactly what it's going to take. It's going to take the market to be in the right spot in 2020. But in the meantime, the pushback on China, and Guy says he doesn't think we get a deal, that's enormously popular in this country right now. Let's be clear. And although we're not a politics show, I just want to talk to you about where policy could still be in the short to medium term. The S&P is effectively at all-time highs. The Federal Reserve, by the way, if anything, look at market conditions. Look at liquidity conditions. Look at risk factors. In other words, the market is actually giving the Fed a lot of room to do almost nothing. When risk assets and the association between essentially household balance sheets and the market is what it is, the Fed does not need to stimulate. The market, Brian talked about this, is doing the Fed's work for them right now.
But can I just push back on something you said?
Sure.
We haven't seen yet the second round of, or I guess would be the third round of tariffs really go through, and I don't know how that resolve will hold up in the face of what will start to be, prices that either companies can't absorb, or that I know we're making billions in tariffs, but let's say the consumer actually has to absorb it. I don't know if that resolve will continue.
Well, I agree with that, and I agree that if we look back on the last 15 months, that the market has never really recovered, even though we really haven't had the teeth of tariffs take hold yet, and it's been about confidence, and ultimately that is a leading indicator, whether it's businesses or whether it's consumers. So, yes, it's a fair pushback. I'm not sure we can quickly flip a switch when it comes time and not have already done irreparable damage to a fragile recovery. What I'm saying is I actually think that the White House understands how important the market is to their reelection. They know how many administrations before them have not been reelected on the market and the economy alone. Nothing else, not policy. People are voting with their wallets, and therefore that's the backstop for investors right now.
So we have a very loyal viewer base. They
sure we do.
watch every day, very,
Almost to a
devoted,
man and woman.
Right, exactly.
Yep.
So I'm going to marry what we talked about yesterday in the A block with what we're talking about.
Oh, yesterday's
right now.
A block?
I know you can't remember it, so I will refresh everybody's
Were you
memory.
here?
And that
Oh, I
is,
was here.
we ask whether or not the market's at these levels, which is, it's higher.
Oh, yeah, I remember that one.
Value trade or value trap, and you surprisingly said it was a value trade.
Yes, I did. Remember that? And you're like, and I started the show by saying, you bet you think you're in my head, but you're wrong.
So today, do you still agree with that?
Yeah, no, I do still agree, because I don't think the
So
reason.
you still buy into this market 1% away from record highs?
Listen, the market has gone down for over the years for many reasons, not least of which have been a forward multiple. So it doesn't have to be an expensive market for the market to sell off. I think the least of the market's problems is a valuation that's expensive. I don't think it is, which is why I think the S&P is a value trade. However, the other factors going on right now, to me, outweigh them all, and that's why I think at a 15 VIX and an S&P at an all-time high, with people hoping there's a G20 China trade deal and hoping that the Fed is somehow more dovish than they've been, I just think you're really in the deep end of the pool at this point.
Okay, so let me focus the question a little bit more
Thank
on
you.
the things that rallied in today's session. That would be raw materials, right? Commodities really went
Sold
higher.
to you.
Okay.
Sold to you, and I think those are value traps. I mean, let's think about one of the reasons that people think that commodities might go higher is because the Fed's going to cut rates. You think you get a weaker dollar. I would make a bet that the dollar actually gets stronger if the Fed cuts rates, because the entire world is now going to come in and start buying U.S. bonds. So that's not going to be good for commodities. Take it one step further, that's not going to be good for multinationals. So take it a third step now. I'm on my third derivative here to the S&P 500. For the last year, we've traded in a range, a huge range, but we've basically traded sideways. What catalyst out there is there today that there wasn't there yesterday that's going to break us out? I would argue that we don't have a new catalyst. And in fact, this G20 meeting, why would the Chinese at the G20 meeting come and say, hey, we're going to make a deal right now? Why wouldn't they drag it out until the election?
It's interesting. The editor of the Global Times, which is often cited as having sort of a hotline to the Chinese Communist Party, he tweeted that...
The communist whisperer?
Yeah, exactly. the she whisperer.
Okay.
The she whisperer basically tweeted today that the meeting, the G20 meeting between Trump and Xi, was at the request of the United States. The way it's being positioned, just as we think that there is somehow a leg up in the United States, in China they think the opposite.
Well, I know, and the protests in Hong Kong are another reason to believe that there's no way that Xi wants to go into the G20 with at least some strife, in his region, certainly in their area of domain. Back to commodities, copper was up over 2% today, and copper and oil really have been taking a beating. But if you look at the bottom-up story, leaving aside global macro, but look at the bottom-up of how some of the miners in iron ore and copper have been run. The fact of the matter is, if anything, we're going to possibly get some some stimulus in the form of infrastructure. We continue to get One Belt, One Road. These are all supporting. If you talk to miners around the world, iron ore prices above 100 are not going anywhere anytime soon. So I kind of like these trades. Look, I've liked steel, not because I've been happy about steel tariffs, but because I thought that the valuation of U.S. steel was, and that was 30% ago. So I'm wearing that one. I have to like it here, and I do think that the inputs to steel ultimately are better for steel prices.